Welcome everybody, great to be with you. My name is David McMeekin, and I'm an instructor based out of London. And today we have Capital Market Expectations Parts 1 and 2. Now, as far as 2020, some things to tell you about as far as this is an area that has changed to some degree. So we have two readings, reading 10 and reading 11, and the first reading here has only got some small minor changes, but they are important enough certainly to draw your attention, especially to one or two little subtle changes, I would say, but mostly largely the same. Whereas part 2, the second reading, has a lot more of a major change. And this is quite a big thing for us at level 3 because it hasn't changed in quite a number of years. Okay, so we have some slides for you. Let's have a look at the big picture before we start into the detail. So when you look at the whole area of economics, guys, here at level 3, remember that the investor policy statement has been done. And where we're heading towards after this particular session is asset allocation. And in the middle, we have the very famous mean variance optimization. Guys, where you'll know that the mean here is the return, the mean is the return, the variance, of course, is the risk, and the optimization, of course, is getting the right balance of risk and return. So one of the main objectives of this whole session that we have are the inputs we're going to need, guys, the inputs we're going to need for our famous MVO. These are the kind of main focus of this whole session. So one of the first inputs we're going to need to forecast expected returns for the assets that we're thinking of and choosing our assets based upon those. Also, guys, thinking about our volatility, what's the risk involved of these looking ahead. And this, looking back at the past will be one useful tool, but looking forward will be a useful tool as well, some of the models that we have. And guys, the last thing here is going to be the correlations. What are the relationships between the assets moving forward as well? So putting a context to the whole session, a lot of what we see is all about thinking about the inputs to our planning and using those inputs then to choose our asset allocation. And then where we're headed with the asset allocation, guys, is the famous efficient frontier. We're going to use the MVO software. Here is the return and here is the risk. And one of the main ideas, guys, is to create our asset allocation efficient frontier. And that material all comes up in the asset allocation area. Now, a few things before we start that's quite useful to think about is that the fundamental law of investing is mentioned early on, and it talks about the uncertainty of the future. So if anyone could manage to get this perfectly right, that they have to have a crystal ball. We know that's not possible. So they use the term approximately right. If you get it approximately right, you'll be doing very well indeed. In fact, it's pretty unrealistic to get it right all the time. Now, one final thing, guys, before we talk about here is if I asked you what's the primary determinant of returns, here they are here mentioned. What's the primary driver or determinant of returns? Well, guys, asset allocations is the CFA answer here. So let's have a look at our expectations in this area. Now, the first area starts with a bit of a model and a plan, I suppose. And it starts off, you'll recognize, with our investor policy statement. CFA level 3 all the time goes back to a client scenario, and from this client scenario, what is their time horizon? Are they an individual client, a high net worth client? Are they an institution like a pension fund or a life insurance company or a general insurance company? And what we're saying here is try and tailor what we're doing to the client itself. When we talk about defining allowable asset classes, they are thinking as well about things like sectors as well, thinking about geography as well, thinking about a bit more detail, kind of a granularity as they call it, a bit more detail, equities, bonds, thinking about other asset classes as well too. Now, a lot of the readings do link in looking at the past. But they also add on here, guys, the idea of judgment. Looking at historical data alone isn't enough because the future might be nothing like the past. So when they talk about, use the term a shrinkage technique. I'm going to mention it early on. They call it a shrinkage technique. Whenever you see this term shrinkage technique mentioned in the slides, they mean having kind of two forecasts, perhaps one based upon the past and one based upon your own judgment, and then having some kind of a weighting. The idea of two heads are better than one, kind of two forecasts are better than one as well. So yes, we're going to use the past, but it might not necessarily be great for our future time period. Now, one change in this area compared to, say, the last 10 years or so, is the number of models has fallen. So in the 2020 material, we have some of the old favourites like Grunwald and Kroner, and we have Singer and Terha as well, the Taylor rule, but we've lost probably 4 or 5 of the other ones as well. So you will see a lot of references, guys, later on to Grunwald and Kroner, also Singer and Terha, both kind of equity return models, and the famous Taylor rule coming up as well. And I think you recognise the Taylor rule from level 2. But just beware, if you're going back over any past papers, past AM papers, just beware that the reading to's changed quite dramatically and some of the older models are no longer there. When you think about the sources of information, guys, and data that's around, I guess in real life now, and the CFA syllabus has reflected this, there's a lot more focus on things like fintech, a lot more focus on social media, a lot more focus on a wider range of data coming through, of course, as well, giving you a much closer to what's actually happening. In fact, probably an overload of data 24/7, of course. So the plan continues here, and you notice that it's not just a focus on a method, it's not just a focus on a model, that this whole area, people don't agree. You think about economists and forecasts, that we all have a viewpoint, and you know from your CFA backgrounds there's a wide range of different participants and different goals and objectives. Many have very different views about how to interpret what's going on at the moment. Here in the UK, as this video is being recorded, we're in the middle of a Brexit storm. Who knows what's going to happen in terms of politics, even in the next month or two. We have deadlines approaching, I guess that's pretty common. No one can foresee what's going to happen with any certainty. So based upon our judgment, looking at the past data, looking at our view from our models as well, we're going to make some choices and make some estimations and forecasts. Our own view, guys, our capital market expectation view that we can use for our clients and our planning as well. Now, things change very quickly. For example, guys, new tax years, you get new political parties in power. The geopolitical environment can change very quickly as well. As this idea of monitoring and changing, goes the economy. One of the things that's pretty nice about this chapter I'm going to mention as well is that you know quite a bit of it already. If you think back to level 1 economics and level 2 economics in CFA, you know quite a bit about the business cycle. All that is back for level 3 one more time. In fact, quite a few things here in this session, like the Taylor rule that you've seen before as well. So when we're talking about looking at asset classes themselves, we're thinking about the beta, the market returns for equities, market returns for bonds, and they call that beta research. Not as much focus in this reading about the stock picking or the individual companies, it's much more about the big asset class itself. Okay, so let's talk about forecasts a bit more here. And whenever you see in level 3 kind of a list of rules, list of ideas or ideas coming through, consistent, unbiased, objective, well, we're going to see there are some human nature things coming in here, which we're now going to call these biases. And biases from you and I, from analysts, the kind of human biases coming through. I've got a mnemonic coming in for this I'm going to show you in a moment, but I always remember this as OAS. Here we have an old age person, and should you sack them? I'm sure it's quite inappropriate, but an OAP sack, but that's the way to remember this one here. And we have some biases coming in very shortly, guys, that we'll use this mnemonic very shortly as well. What the book says, though, about this area, it says that for any kind of data, you should really have a sample of at least 30. guys, your sample size should be at least 30. It's going to help in terms of relying upon some of these judgments that you're going to be making here. Okay, so we've talked about forecasting is inherently wrong and inherently difficult. We can't see ahead in the future. The book reminds us of this. And one of the first things we look at is that when you think about lots of data, well, at the time you have to wait for it. You're not going to be able to see what's happening immediately. For example, when you think about GDP data, that can be a quarterly lag. But the text talks a bit more about, for example, in emerging markets, some of the data can be delayed 2 years or so. So having to make decisions, because when you don't have the data, is quite tough to do. Are we in a recession? Are we not in a recession? And there is a bias here called look-ahead bias. Just going to mention this, mentioned in the text. Yeah, a look-ahead bias is if you were to forget this lag, when you look back at all the data, it's all available to you, but it wouldn't have been available to you at the time. Also, when you think about how often definitions of data changes, we think about unemployment data changing and methodologies for inflation changing as well. Very hard to compare different time periods. And in fact, some of these indices we've talked about here are often rebased. They start again. And again, if you were looking at a whole time series of data, you might forget. Maybe harder to compare them if you have a rebasing going on as well. Now, whenever I see certain slides, I'm reminded of past questions. So one tip I would give you would be, unlike the other levels, remember that level 3 here, they do publish, I'm sure we have it on your online portal, guys, the past AM, of course, AM papers. We know they don't publish the PM, only the AM, and of course, as well as the AM actual papers, they also have the worked answers. Now, a bit of a warning that some of it's changed. I mentioned about reading 2 having changed. However, in this first reading, whenever I see a slide like this one, I'm reminded of a really good practice questions that you'll find, especially when we go through some of these past papers online with you. Guys, in your portal, you can see access to these, of course. And the kind of question that often came up from the past here were definitions of each, and you had to name the biases, name these challenges in the forecasting here. So let's run through them here. If there's a transcription error, then the input, I suppose, the original data that was input was entered incorrectly. That could happen, a transcription error. Now, survivorship bias, if the data, particularly is one we see in the hedge fund area for alternatives. In the area of alternatives, I guess the data requirements are a lot looser, don't have to report a number of things, whereas perhaps in the more mutual fund world, a lot more has to be reported. But guys, imagine if you only reported the winners. If you only reported the winners, and they're the ones that are the survivors, they get reported, but what they don't report are the losing investments, guys, the losers, the losing funds. If the losing investments or assets are not reported, then you're going to get an upward bias in all your data. So the idea, guys, of survivorship bias is to be very aware of certain data. And in CFA level 3, I guess it's in the alternative area, be particularly aware of this with our hedge funds. What that's going to do, if we take out the losers, you're not going to get the same volatility either. The winners perhaps have more of an upward trajectory, but the losers, you're going to miss out on some of the risk. The other famous one to be aware of is our appraisal data. If I ask you what kind of asset classes are we thinking about here? Well, we're thinking about 2, of course, main ones here. Guys, we're thinking about real estate, and we're thinking about private equity as well. What do they have in common when you think about real estate and private equity? Why are these a problem here? Because they don't have many transactions. The building that we're in today, Kaplan building here in London, I wonder when it last sold. It's probably been Kaplan for years and years and years. If you were estimating the value of this building, you'd have to have some kind of a guesstimate. So this idea of a pure appraisal or estimate is a very different thing from a transaction. If you have, guys, an equity or a bond or other transaction, hundreds of shares have been bought and sold in the last day perhaps, you can have a clear idea of prices. And this idea of smoothing comes from this appraisal problem. Now, in CFA level 3, just going to draw your attention, guys, to the Global Investment Performance Standards. That has a lot to say about appraisals, has a lot to say about these two areas. I know within our structure of our readings, GIPS comes quite early in 2020, which is good. I definitely encourage you to have a look over those two areas. They have their own section there. Now, one of the problems with these two areas in appraisal data is that when you are estimating the volatility, it tends to be the volatility is too low. You tend to underestimate the volatility. That can be a real problem. Let's take an example of this. Let's have perhaps a time zero here, and let's take, I don't know, a period perhaps of maybe 10 years perhaps over here. And notice that in a smooth asset, we just imagine a linear relation in terms of the price changing. But in real life, I guess the price could well be a lot different to that. And the idea of that kind of smoothing is a problem. One way to describe it as well, if I was to draw your portfolio, let's take some real estate over here. And let's have this idea of appraisals. So we're using these appraisals here, smoothing. Now the rest of your portfolio is, let's call it normal. So it is quite volatile. The standard deviation there is quite a bit higher. So let me ask you about the correlations. What would the correlations be between these two elements of your portfolio? I guess the answer would be the correlation would probably be quite low. Now the reason it would be quite low is it would be low in a fake way. It would falsely look low because your normal assets, they are quite volatile up and down, whereas real estate is quite smooth in this way. And it would make you falsely think that, well, over-allocate to real estate. So this idea of your risk calculations are going to be understated, and you may well allocate far too much to this real estate area, when in fact, as I said, this is fake. In real life, the data is fooling you through the smoothing. So these illiquid assets we've talked about, like real estate and private equity, the heart of the problem is they're infrequently traded. Now, when you look at data, we often, of course, can look back at the past. But what this slide has quite an interesting warning, really. I'm going to draw on a very famous diagram here in risk, and it's called the negative skew. Let's just make a note of the negative skew here. And the negative skew is saying beware these low frequency, high impact events. The high frequency, low impact, these high frequency, small profits, but beware the fact the tail might come and hit you with terrible losses. So what the book is saying here is that sometimes when you look at the ex post data, well, it has been relatively calm. It was a calm period. And this particular risk never happened. But it's not to say it could never happen. Because the negative skew is warning you. And linking to level 3, there are quite a number of places we're going to see, even in our economics, where a negative skew exists. And one of them that comes to mind, guys, we're going to see is in the area of emerging markets. They liken this idea of a negative skew to picking up the dimes in front of a steamroller. That be careful because the steamroller could suddenly hit you. The idea that things can change. So when you are looking forward ex ante, this idea of ex ante risk, the idea of looking at expected returns, just because it hasn't happened in the past doesn't mean it couldn't happen in the future. Yeah, that's our main message here. And when you look back at past data also, we're talking about some of the idea of regime changes. Going back to, say, interest rates, here in the UK, interest rates in 1990 were 15.4. Can you believe that, guys? 15.4%. Thinking about deposits, earning cash rates, extremely high rates. Where are we more modern times? Well, more modern times, up to the current day, if you like, around about 0.75%. So the era or the regime of high interest rates hasn't been with us for a long time. I mean, a staff mortgage at 5% back then was absolutely wonderful if you were in the banking area here. So whether it might be, guys, a regime change in terms of policies or fiscal policies or political or taxation, these things can be very different. If the data's changed, the term you'll recognize is non-stationary, meaning that it's not stationary and the relationships have changed. So things like the volatility, things like the using the data makes it a lot harder to use if the fundamentals have changed. Now, choosing the time period when you're looking back at the past, even in recent times, if you think about the crisis that we've been through, of course, 2008 and that period here, and you could argue that the 10 years before was a lot more normal times. And they are giving us this recommendation here that we should try and use longer time periods would be better than the shorter ones. For example, if you went further back to 1998, you would have found, of course, a lot more volatility. We have a few areas coming in terms of emerging market volatility, a Russian crisis in 98. But that's the main message here. Try and look for a longer time period. The more frequency you have in your data, that's going to help, but you are looking at over a longer time period. Now, I mentioned about our human biases. We'll talk about these in a moment, coming in shortly as well too. But so the first two are more in our processes, I suppose. If you keep looking for something, well, you will find it. You'll find it. It might not necessarily mean a lot. So this idea of over-analyzing, overfitting the data, they call that data mining. An interesting example they give for time period bias is in the area of small cap stocks. This is quite an interesting one. I'll give you a couple of numbers on this one. Yeah, what's quite interesting here was the time period for small cap returns was very different. Now, it's quite well known that do small caps outperform? Do they kind of outperform over every time period? Well, we have a number quoted, guys, here from 1975 period all the way through 1983, and it's quite a healthy 16.85 per year. Okay, 16.85 per year. But if we change the time period, and 1984 through to 2014, well, the data is quite surprising, 0.09. So this idea of the time period that you choose, one theory perhaps for this is that once an idea is discovered, once that idea is out there, that a lot of people copy it, and there's less kind of alpha available for you trying it in later years. When they talk about conditioning the data, we're in the area, of course, economics, and it wouldn't be right not to mention economic conditions pretty early on. So let's bring this in here. When you're in your boom time, or when you're kind of in more of a downturn, have you factored in those changes into your forecast? So an unconditional forecast, you have an unconditional forecast, I guess, would be more of an average, if you kind of an average over the whole period. But a conditional forecast, you would incorporate the economic conditions at that time. When we talk about relationships as well, it's quite a common one, as CFA often mentions, correlation and causation. Does A cause B, or is it the other way around? The one that always I think about when I think about here is perhaps a crime area, a high crime area, have a lot of police based in that particular crime area. Do the high police, is that causing the crime, or the other way around? Or is there something else? Is it the economic conditions? Is it the local conditions that in that area, the unemployment area, or is it perhaps something else that's causing that? And the idea here is to try and look beyond just the numbers. I mentioned about the mnemonic that we have here for you, and in 2020, the recallability trap just has slightly been renamed to the availability. Now the idea about the recallability is you kind of incorporate what's around you, what you can recall quite easily. For example, if you work in IT, you're surrounded by IT information at IT companies, well, you're probably going to be a bit more biased towards that particular sector. So just be aware that for 2020, that's the only slight little change. And I have this mnemonic that I quite like, and I think about this OAP, and a bit mean perhaps, but I have to sack them from my team, not because they're doing anything wrong, but that's the idea here. So in my OAP, I've got the overconfidence comes first. Guys, the idea that human nature, we're overconfident in our abilities as in forecasting. Got two A's coming in here. You could have had the anchoring, we're too anchored to a past value, guys, to the initial information, we're too anchored. The P here, guys, the prudence, our forecasts are too cautious in that way. We're too prudent, we stick too close perhaps, too cautious around what we're doing. We also have the S, guys, here, which is the status quo. We stick to what the current level is, sticking with our kind of current situation, rather than nothing's going to change too much. Our second A, guys, the availability we've talked about, but biasing a bit towards the sector or the information around us too. And then lastly, the confirming evidence that we have a lot of people around us, and we are looking for people who agree with us. Confirming evidence, we're looking for people who agree with what we believe ourselves. Now, before we leave this slide, I want to link to a previous area, which is behavioral finance. Because what we have here is we do have 5 of these that are covered in the behavioral finance area. Guys, anchoring is a cognitive bias. Status quo trap there is an emotional bias. Confirming evidence is a cognitive bias. Overconfidence is an emotional bias, and the availability here is also a cognitive bias. So 5 of these you know already, from your behavioral finance work. And the prudence one, you could argue, is quite similar to which one? Think about the missing one that isn't there, conservatism. So this slide has been tested, and going back over the past papers from those morning papers, you will find one under, in this particular question from the past, they didn't give you the names, because they didn't give you those names, so remembering the OAP SAC will help you remember these biases. Now, when you think about the reliance upon models, we have a number of models coming up today. So, for example, Grinold and Kroner, we have Singer and Terha, we have the Taylor rule coming up, to name but 3 here. So selecting the wrong model, and I guess the frame for this one, guys, the context, the 2007, the famous crisis. What are we kind of thinking about here, especially perhaps the mortgage-backed securities and the CDOs? They would be certainly one example of this. And one of the problems here are within the model, guys, would be the correlations that were assumed. The inputs into the model are the correlations, the relationships between the borrowers and the mortgages. Who would have known, who would have thought the kind of common link, the common high correlations there. Also, if you think about, guys, things like normal distributions, relying upon normal conditions, we know in a crisis period there certainly aren't going to be normal conditions at all. So to finish off this first segment, kind of sets the scene what's coming up shortly. The models that we've talked about, things like Singer and Terha coming up, and Grinold and Kroner, they do come up later on as well. We are going to look at a variety of different methods. Some will involve the analyst's own judgment that we've mentioned already, and we will look at some different tools and things you've recognised before, like our cash flow models.